record. Okay. So number 2, what amount should an enterprise capitalize as intangible assets? What amount? Okay. So far we have introduced about the definition, recognition. So you want to recognize these are the intangible assets. Then the second question is the measurement. What amount of the cost should be capitalized as the intangible assets, right? So you want to make sure that the asset will be recognized if and only if, okay, the expected future economic benefit is probable, right? If there's no future economic benefit, you cannot recognize the intangible asset. Okay, so for example, I won't consider myself as a computer expert, but I'm able to write softwares, right? Very simple ones, right? And then I would recognize the cost as an intangible asset. That's not appropriate because my softwares may not have a market, right? It's just not sophisticated enough to make the customers to buy, right? So if it's not probable, right, I'm gonna receive future benefit, right? So then you should not recognize this cost as intangible assets, right? And the cost of the asset has to be measured reliably, right? Remember, if anything that cannot be measured reliably, you should not recognize it, right? That's exactly why we do not recognize the value of the UFL president, right? Because you cannot measure it reliably, right? So in order to recognize an asset, first of all, the future benefit has to be probable. Second of all, the cost of the asset has to be measured reliably, okay? Otherwise, your number, if you present an unreliable number, how that's going to help the user? Think about that, right? If the cost of the asset cannot be measured reliably, the number you presented is not reliable, then you better not just present it, right? Because it's not helpful, right? It's not relevant. So management have to use some reasonable and assumptions to make estimations on the expected benefits, okay? So there are some judgment estimations involved, okay? So you could get intangible asset in 2 ways, right? You either buy it from somebody else, right, by requisition, or you developed your own intangible assets. This is not a new concept, right? So similar ideas, when you have a building, you can buy a building from another people, right? Or you can self-construct a building on your own, right? Similar ideas here for the intangible assets, right? So for the acquired intangible, okay, it's probably easy to satisfy recognition and measurement, right? So if the expected future economic benefit is not probable, why would you buy it, right? The fact this thing has a market, that means it is valuable, right? There is benefit associated with this asset, right? And the cost, well, whatever you pay, that's the cost of the asset, right? You can measure it very reliably. So what we are saying here is for acquired intangibles, these 2 criteria can be satisfied, right? For acquired intangibles. For internally developed tangibles, okay, that's kind of hard, right? If you developed these intangible assets on your own, and you're gonna ask yourself, is it probable it's gonna have benefit? Can I measure the cost reliably, right? So that's a little bit of tougher question to answer, okay? Because you are developing this on your own, there may be not a market there, right? So IFRS will impose strict criteria, okay, for the internally developed intangibles. Okay, The reasons are, it's the reliability of measuring the benefit is lower, right? Okay, and the bias. Okay, if you develop something, you have a bias of thinking all the good things about it. You have a bias of being really positive, right? Okay, so because you develop this stuff, you tend to be too optimistic, right? In terms of these estimates, right? There's a bias. Remember, I'm going to show you this picture. So we call it mom's bias, right? In mom's eyes, their baby is all beautiful, right? No baby is ugly, right? To the moms, no baby is ugly. So where you develop something, you have a bias, right? You think all the good merits about it. Okay. So for internally developed intangibles, okay. So, oops. Okay. So I don't know. Okay. Acquired. Okay. So acquired intangibles. Okay. You record the acquired intangibles at fair value on the acquisition date. Okay. So basically, here is one example. Okay, it should be quite straightforward. Okay, so this is one example of acquired intangibles. A professional sports team and its related items, including a stadium, were bought by an exceedingly wealthy investor and sports fan. The negotiated price is 175 million. Details of what was purchased and the agreed fair value are as follow. Okay, the team has been very successful in its league, has been recording $5 to $10 million income every year. Okay, so the items list including stadium, land, cable television broadcasting contract, player contracts, spectacular leases on luxury viewing boxes, product licensing agreements, season ticket subscriber list, contracts and commitment for use of stadium, the team, okay, imputed or residual value, okay? So that add up to be 175,000, okay? So first of all, tell me which items are the intangible asset. So again,
the subscriber list.
Oh, list, yeah, that's right. Subscriber list.
Is it the contracts?
Which one?
The player contracts, maybe?
Player contracts, yes.
The product licensing agreement.
Okay. Product licensing agreement.
And then list, the seasonal ticket subscriber list.
Yes.
Does the residual value qualify as goodwill here?
Okay, very good. This is goodwill, right? This is goodwill. The company, the team is being really successful in its league. Every year they are reporting good income, right? So they are willing to pay extra money. That's the residual value. So that's the goodwill, right? Okay. Are there any other intangible assets? Stadium, is this intangible?
No.
No.
The broadcasting contract would be intangible.
This is intangible, yes. Land, is land intangible?
No.
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 How about the leases? Leases on luxury viewing boxes.
Yes.
Okay, very good. How about the contracts and the commitments for use of the stadium?
Yes.
Yeah, good. So think about this definition, right? first of all, is this contract commitment for use of stadium is identifiable? Yes, right? This contract commitment can be separated from other assets, right? And it's a right due to contractual rights, right? Due to contractual rights or legal rights, right?
Yeah.
Is this non-monetary nature? Yes, it's not a dividend, right? It's not giving you a dividend or interest income, right? It's really about a contract that a business contract, right? So people, if they use your stadium, right, they are going to pay you a certain amount of money, right? So it's non-monetary, okay? And is this lack of physical substance? Does the contracts and commitment has physical substance?
No.
No. Yeah. So then you see, this all the criteria has been satisfied, right? So therefore, this is the contract. This is the intangible assets, right? Okay. So is it probable to realize the future benefit? So for example, cable television broadcasting contract, right? Is this probable to realize the future benefit?
Yes.
Yes.
Yes, right? Okay. And can you measure the value of this contract?
Yes.
How can you measure?
The amount it was agreed upon.
Yes, right? So the future cash flows, right? You're going to discount the present value of the future cash flows, right? So according to the contract, right, you know, the broadcasting television cable, we will agree to pay you for a certain amount of money, right? And each year for so many years, right? And then you're going to discount those future cash flows to calculate the present value, right? So you can actually measure these values reliably, right? How about product licensing agreement? Similar idea, right? It's probable to realize the benefit, right? The product licensing agreement. Again, you're going to use the present value of the future cash flows to measure it, right? So in this case, the first two items are tangible assets, right? PPE. The last item is goodwill. So the 7 items between, these are all intangible assets, okay? These are all intangible assets, okay? So you can separately, so these items are either, it's contracts, right? It's contractual. These items is identifiable because it's a right from this contractual rights, right? And it's non-monetary nature, right? The contract itself does not promise you the money, right? It has to be the use of your assets, right? When people use your boxes, right? When people are broadcasting your sports, when people are using your stadiums, right? When people are buying your season tickets, right? You see, it's not purely monetary transaction, right? There is, behind it is a business transaction. So they are monetary, right? They are non-monetary, right? And it's lack of physical substance, right? Lack of physical substance. The value of this contract has no substance, physical substance, right? The paper, the value of this contract is not because of the paper, right? You are not, its valuable is not because you printed on a very expensive paper, right? I don't know how expensive paper can be, but the whole point is this contract commitment lack of physical substance. Therefore, this is all intangible assets. Does that make sense?
Yeah, so it's like a safe rule to say that anything that isn't physical, that you can't put your hands on, is intangible. Is that kind of a safe way to
But
look
you
at
have to
it?
be careful, right? The bond, right? Think about the bond instrument, equity instrument, shares, derivatives, right? This asset also have a lack of physical substance, right? But they are financial assets. They are not intangible assets because in nature they are monetary. Does that make sense?
Yeah, that does. So I guess it's a good starting point, but not a good rule.
Yeah, you have to be careful, right? You have to be really careful. First, is that tangible or intangible, right? If intangible, is this financial or it's intangible, right? So
Okay, yeah, that makes sense.
all goodwill, right? All goodwill.
Yeah, okay.
Okay. So you can see that this is the when you acquire intangibles, you can acquire these intangible assets, right? When you buy this company. Okay, so this is just some kind of explanations about, in case you don't know what this agreements, contracts, what are they, what they are, there are some kind of explanations. Okay. Okay, B, internally developed tangibles. Okay, internally developed intangibles. So when I was preparing the slides, I was thinking about what would be a good example for this. So I was thinking about the company, right? They are the pharmaceutical companies, right? They are inventing these vaccinations, right? COVID-19, right? So right now, good news. There are 2 companies already declared the success, right? I heard by March next year, I think Canada will get maybe 6 million doses. I heard, but I think a third of that will go to Ontario. Okay, so the rest of the provinces will share the 4 million doses. Okay, and of course the senior people should get it first, and then the medical professionals, staffs, they should get it. So by the time people like you and me get it, it may be already the end of the next year. Okay, so I think it's positive, but it's still gonna take some time before this whole thing will settle. Okay, so stay safe. Okay. So then you think about these pharmaceutical companies, right? They are really on the innovation, right? They constantly developed their patent, right? Develop medicines, develop vaccinations, right? So they do research and they develop all these things. And so generally, we are saying that there are 2 phases. So research phase versus development phase, right? So let's still use this COVID-19 as example, right? So now, people see there's a big market for the huge demand for this product, right? Okay, that financial incentives motivate lots of research teams, right? They were conducting experiment research work to figure out what would be a mechanisms to deal with this virus, right? So that's the research, right? You're gonna be able to find out a way to stop the virus before it's. I'm not a biologist, right? I'm not a doctor, so I don't know all these ins and outs. But the idea is you need to invent mechanisms that will stop the spread of the virus, right? In your body, right? So you're gonna control it. You don't want this virus duplicate itself inside your body, right? So then lots of research involved, right? The scientists, research teams, many peoples. It costs a lot of money, right? costs a lot of money. Okay. And then, some research teams will be successful. They have a great success. They have a good funding, right? So next step, they're gonna deal with the applications of this research funding, right? They are going to develop this product, right? So the accounting treatment for the two stages are different, okay? In order to have this cost to be capitalized, there are, okay, specific criteria, okay, to be met, okay? So what happened is for the research stage, okay, for the research stage, you have no product yet. You are just doing experiments. You are just trying to increase your knowledge, right? You are just trying to gain that knowledge, right? You want to gain the knowledge how to battle this virus, right? So this is a research process. So any cost involved in the research phase is always expensed according to IFRS, okay? You have to expense the research costs, okay? Because you don't have a product yet, right? You don't have this vaccination yet. You don't even know if you can ever find a solution, not even mention about a product, a cure, right? So then this cost will be all expensed, okay? And then this does not mean all the cost in the development phase will qualify for capitalization, okay? This does not mean that the minute you get a solution, your research findings is very positive, and since then you start capitalizing your cost. No, that does not mean that. Certain costs in the development phase will be also have to be expensed, okay? Development stage. So this is the stage you're gonna apply your research findings, right, to an actual product, right? In our example is the vaccination, right, the vaccine, right? The development cost can be capitalized if all 6 criteria are satisfied, okay? So at the minute all the 6 criteria are satisfied, you can capitalize your cost, okay? What are the 6 criteria, okay? What are the 6 criteria? So an intangible asset arising from development shall be recognized if and only if an entity can demonstrate all of the following 6 criteria. Okay, not just one of them, it's all of them. All of the 6 criteria, okay? First one, technical feasibility, completing the intangible asset, okay? Do you have enough competence, right? Technically, are you able to invent this vaccine, right? Do you have all the equipment, all the technology that are available that will eventually help you to finish this vaccine, this product, okay? Intention. Do you want to develop it, use it, or sell it? Does that pharmaceutical company have the intention to get this finished product and sell it, right? In our example, yes, right? There's lots of money involved, right? So the pharmaceutical companies have this intention to complete this vaccination, right? Ability to use or sell this asset, okay? Do you have the ability to sell it? Yeah, of course you have, right? If it's proved to be useful, and all the countries will come to you to make orders, right? How the intangible asset will generate profitable future economic benefits. Is there a market? Yes. Everyone need COVID-19 vaccines, right? So if you use it internally, is this asset useful? right? So that's not the case for vaccine, right? The vaccine is more for selling, right? Not for internal use. Okay, availability of adequate technical, financial, and other resources to complete development. So do you think the pharmaceutical companies receive enough financial fundings? Do they have enough technical resources, smart people working with them to finish this development of the vaccine? Right? Yes, right? The US government, they have this program, they throw lots of money, right, to help company develop vaccines. Ability to measure reliably the expenditures attributable to the intangible asset during its development. Yes, right? Yes. You'll be able to capture the cost for the research teams, right? For all the cost involved with the vaccine development. So as you can see, there are 6 criteria here. 6 criteria. The first 2 worried about, are you able to get this done? Okay, so you have a good idea. Are you able to carry it through to have a final product, right? So A and B is really about if you're gonna have a finished product. A concerned you are not capable, okay? B is concerned you are not willing, okay? So that's the first 2 criteria. C, D, okay, C, D are more concerned about market, right? Is this gonna be useful? Is this gonna have a market? Do you have a market, right? Will people come to buy your stuffs, right? The output of this asset. Do you think people will come to buy your vaccine, right? That's the C and D, right? And E and F, E is about, again, this is about completion, right? They are concerned if you are able to complete it, right? Do you have enough things to finish this whole product, right? Sometimes something is so expensive, right? Eventually you run out of money. You have to give up because you are out of gas. You are out of gas, right? Because some technologies is so much cash burning, right? So you don't have enough resources to finish it, right? So you could have the best product, but it's too expensive. You're just not able to finish it. And then what's the F? F is the, again, it's about measurement, right? So you are able to get all these things, good things, benefits, right, whatever, but are you able to measure it reliably? Okay. Okay, do we have any questions?